Well, class is in session, and today we're talking about cold, hard cash. And like me, cash flows in and cash flows out. So no matter what my income looks like, I need to spend cash to feed myself, but I also need to make sure I have enough cash on hand to make sure I can feed myself tomorrow. So businesses are actually the same way, and public companies provide financial statements as a bill of health for investors to look over every quarter. So here is an income statement. This is one of the three major financial statements, and in this case, we're looking at the net income for my company. That's CHEUNG'S. I manufacture sneakers. This is a very rudimentary version, but pretty easy stuff here, right? So I sold $40 million in shoes for the last quarter, but that doesn't mean that my profit was $40 million, right? So I had to pay $35 million to make those shoes, which means that my net income was actually $5 million. So you look at this statement and you say, hey, things look pretty good, right? Well, not so fast. If you think about it, how do I know that all $5 million is in cash that I have today? Well, the cash flow statement actually shows you this. So it actually shows you the nuances of how cash is flowing in and out of a company over a given period. So the cash flow statement is broadly broken out into three categories. That's operating, investing, and financing. So first, we have operating activities, and here's an example of a segment on a cash flow statement. So CHEUNG'S made net income of $5 million in this quarter, as you recently saw. Now, under generally accepted accounting principles, I have to depreciate the value of any machines that I use to make my sneakers from my net income. But that's not an actual cash charge. So yeah, sure, my machines are worth less than they were when I bought them, but that's not necessarily cash leaving my pocket. So on the cash flow statement, I'll actually add back depreciation, which in this case was $1 million. Well, then there's also accounts receivable. So, okay, I sold $40 million in shoes. That's great. But some of the stores that sold my shoes haven't actually paid me the money yet. And they just told me, hey, we made the sales and the check is actually on the way. But since I don't have the money yet, I'm actually going to deduct the money that I'm owed, which in this case is $3 million. So you add all of this together, and the actual cash generated from my operating activities is $3 million. So next up is investing activities, and this is pretty simple. So expenses that I had to pay up in cash for, so things like buying a new building or the enormous costs of launching that takeover bid of my rival CHEUNG'S, which is run by my Yahoo Finance colleague, Heidi Chung. She's not even here today. But these all require cash, so there's a $7 million net outflow as a result of those investing activities. Then the third bit, financing activities. So companies can raise funds in a number of different ways, right? They can raise money by issuing equity like stock or by issuing debt like corporate bonds. In this case, I've actually done both. So I've raised $1 million in each of them for this quarter. But I need to pay out on previously issued debt in previous quarters as well. And it hasn't been good for CHEUNG'S. So the enormous debt that I've tried to use to cover my cash position, it's costing me $4 million this quarter. And by the way, other examples of financing outflows would include paying dividends or initiating stock buybacks. But in my case, all of this is actually requiring cash. So my net outflows are $2 million. So then we take all those three things and we put them together. So what we have is actually beginning balances. So we start off with $8 million, and I'm going to add the $3 million from operating, subtract $8 million from investing, subtract $2 million from financing activities, and you'll see that my ending balance here is $1 million. Very different than from what you saw in the net income, where I had $5 million. So lastly, you may have heard of something called free cash flow. This is something a little bit different. This is the operating cash flow from what I showed you earlier, which is subtracting capital expenditures, which are covered under investing activities. This is a separate measure of cash that's designed to show you how much money exists for financing activities that the company could use to distribute to shareholders, which investors obviously pay attention to. Now, regardless, all of this shows how the income statement doesn't necessarily tell the whole story. So in the case of CHEUNG'S, I was profitable. Okay, that's great. But maybe it wasn't so wise to try a takeover of another company or cover my cash position using a bunch of debt. And this all underscores why cash is important too. That's why there's a reason why it's not net income rules everything around me. It's cash rules everything around me.
Nice.
Hey investors, Zach Guzman here. Are you interested in learning more about the markets and getting the latest financial news? Well, then click right here to subscribe to our Yahoo Finance YouTube channel. Get the latest up-to-the-minute market analysis, big interviews in the world of finance, and information on how to manage your money every day wherever you are.